Hello again, everyone. Thank you for joining us for another NMP webinar. Really appreciate you joining us. This is a really special one here. I know I say this all the time, but this one, I got to say, really means a lot to me. We have with us today Jerry Shiano, who is the CEO of Spring EQ. Jerry, if you don't know Jerry, which I'm going to bet money that probably at least 50% of the people on this line know Jerry. Jerry was founder and CEO of New Penn Financial, which he sold it to ShellPoint. But this is really one of the first non-QM lenders. Jerry saw a huge opportunity in the home equity space, and he led him to create the Spring EQ. Joining with us is John Ehart, who's the Vice President, Third-Party Originations over at Spring EQ. John was a mortgage broker and ran a couple of wholesale lenders, national wholesale lenders. But today what we're focusing on is offering home equity loans as part of your overall strategy. Cool thing I love about this is one of the great things about being a mortgage broker, having access to just a wide variety of products. Both these two guys are just like heroes of wholesale, just do whatever they can to support mortgage brokers. Before we get started here, just kind of want to do just get a feel for where everyone's connecting from. We've got people from all over the country, but if you can, a little chat box on the right-hand side, that is where you're going to be asking your questions, but let me know what city and state you're coming in from. So you just kind of do a little roll call on the right-hand side. Tell us where you're connecting from. So it looks like we got Louisville, Kentucky here. We got Los Angeles. We got Southern California, Seal Beach, California. I don't know where that is. That sounds like an awesome place. Morristown, New Jersey, Las Vegas, Portland, Oregon, that is, Irvine, Malibu, Scarsdale, Bay Area, California, La La Land. Thank you, Tom. But everyone's from all over the country here. Really appreciate everyone for connecting on this. Mobile, Alabama, one of my favorites. Very cool. Thank you, guys. So that little box there on the right-hand side, that's where you're going to ask your questions. If you have any questions, queue them up. You could ask them along the way. We're going to hold all of our questions till the end. Want to basically do whatever we possibly can to kind of answer your questions. But listen, some questions we're not going to be able to get to. We always like to keep this under an hour. And if there are questions that are a little too complicated, we'll make sure that we reach out to you at some time later on, but really appreciate this. And without further ado, John, you ready? You want to take it over?
Yes, sir. Thank you very much. I appreciate everyone attending, and thank you for joining the call. We're going to cover a lot of high-level information today about the home equity segment in our industry, and today specifically focused on standalone second mortgages as part of an overall customer for life strategy, which until now has been a relatively untouched market by mortgage companies and brokers. And the goal for us today is to share what we know about this segment of our business, help you understand how this fits into a current focus as originators, and then provide some resources to make it easier to see how you can execute this at a high level. So before we get into a lot of details, I wanted to ask Jerry some questions. And Jerry, I know that, as Andrew said, you've been on the non-agency side, then the non-QM side. Can you just share with us why you started Spring EQ?
Sure. First of all, good afternoon, everybody. And Andrew, thank you for the forum. Couple of reasons. There is a hole in non-depository mortgage companies' product line. So in the mortgage world, non-depositories, mortgage companies, private mortgage companies have taken over 50% of the marketplace. In home equity, it's really controlled by the banks, depositories, and credit unions. Almost no business is done by mortgage banks and mortgage brokers. And we thought there's just a big hole there. So when you're talking to your customers, a lot of people, a lot of the brokers we talk to, a lot of the bankers we talk to actually refer their customers that they work so hard to source and so hard to please to an organization that's their competitor because they don't offer this product. And my belief is once you refer somebody to a competitor, then they're competing with you against your core products. So we thought by going out there and providing a home equity product, we can give another thing for mortgage brokers and mortgage companies to talk to their customers about, and most importantly, not introduce their hard-fought customers to an organization that wants to compete against them.
Thank you. That's good information. So where do you think this segment is headed right now? I know we're at the leading edge of it, and where do you think we're going to be going with this?
Sure. Like some of the other non-agency products, home equity saw its peak before the great market demise, and it was about $600 and something billion market. Right now it's about a $360 billion market. But there's a 1.5 million to 1.6 million new home equity loans and lines each year. The interesting thing is you take a look at, and we think that market has a good potential to grow. Home equity in houses is strong, and we think that it's a great product to offer people, in addition to cash out refinances. Now, what's happened to that market is the personal loan business has grown through these online lenders, and with really good technology and great consumer experience, they do about $100+ billion a year of personal loans that we think has taken some of the market share out of home equity. We believe, though, that they have higher interest rates and shorter amortization. So what does that mean? Higher payments for customers. We think that by providing home equity with a better experience for customers, and I define better experience as you do it really faster and cheaper, that we think there's a good opportunity for mortgage companies to offer this product regardless of the interest rate cycle. And we think that this segment clearly has an opportunity to grow, and will grow more as rates bump up a little bit from where they are today.
Perfect. So one last question before we dig into some details here. So I know we're going to cover some of this later, but how does this segment support the mortgage companies and loan officers that are on the call with us here today?
That's a great question, John. And that's one that we get asked a lot, because a lot of the mortgage brokers or mortgage companies basically say, why should I offer this product that I make less money on than offer a traditional first mortgage? And our response to that is, when you're talking to a customer, if you're really adding value, you have to understand what their need is. And basically what happens is there's some people who should be in a cash out, some people who should be in a rate and term, and some people who should be in a home equity. This product now gives the brokerage community an opportunity to really go through all of the customer's need and not shy away from one piece of the need. Our product line at Spring does two different products. We offer a combo purchase product, and we offer the standalone product. Now, I think everybody's familiar with the combo purchase product, where you're really helping people choose the best first mortgage, and sometimes you could do that by splitting the first and the second. Today, what we're really talking about is our standalone product, and how the standalone product helps you as part of your customer for life or customer service strategy. Excuse me. So what I'd like to do is spend a few minutes and talk to you about that and the way that we see using this product. It takes us, and it's taken me over the years in various different mortgage companies, a lot of money to generate a customer. And what happens is, if you generate that customer on a purchase basis, you do hard work, you get that customer in the house, and they're in that house, and then maybe you don't talk to them again unless rates dip below a certain point, and then there's a reason to maybe refinance that customer. There's a long time between those rate dips and such, and what we think is, after you put somebody in a house, it's a great reason to call that customer or send that customer a little note after a period of time and ask, how you doing? How's the house? If that customer is like me, after they get in a house, they'll realize they want to have some work done in that house. And we think by offering a home equity product is a great way for you to instigate that conversation that keeps you in touch with the customer that it cost you so much money to generate. Because if you don't do it, The online lenders are doing it. You could see them everywhere digitally. The banks are doing it. And once they get that customer, they don't want to just leave the mortgage to you guys. They want to take that customer off as their overall strategy. Banks do a home equity line, not to do a home equity line, so that they could take a customer into their bank so they could sell them all other products. So we think, and I'm old school, I think it's naturally good to ask your customers how they're doing from time to time. The problem is a lot of our brokers haven't had a product to do that unless it's a cash out refinance. So we think this is a great way to lead into that conversation with the broker. And the irony is, we think the lead in of this strategy will result in not just home equity loans, but we think it will result in refinances and potentially other purchases. It gives you a reason to talk to that customer. That customer may be in the process of moving. That customer may be in the process of buying a investment property. By talking to that customer, you're going to have a good reason to engage, and they're going to remember you. We think that's a real great reason to do it. The other part of that is once your customer is in their home, these customers still begin living their lives. Home improvements are on the rise. Debt consolidation is always a need. And we think by offering somebody the opportunity to help them with their monthly bills, the average customer that we do a debt consolidation on a standalone basis today saves a little bit over $500 a month in payment. I don't know about you guys, but just about everybody I know would like to save about $500 a month in payment. That's a great reason for you to talk to the customer. The second thing is if they're paying for big purchases, college, home improvements, so many other things that some unexpected need, it's a great product to do it. And when you lead with this product, or not lead at this product, when you have this product, you begin being able to talk to the customer about what their true needs are and serve them in the best way possible to put the right product to them. And I'll repeat what I said again. Once again, you'll find that this product may lead to refinances and other first mortgage opportunities for your company.
Perfect. Thank you. Thank you, Jerry.
Listen, I want to just add this. I mean, I think, the idea of staying in touch with your clients, because you've made this commitment to these borrowers from the onset to take care of them, to help them actually with their purchase, and you have this obligation to continue to meet their needs. I hope you guys don't mind. I want to interrupt here, and I want to launch a poll because I want to know from the audience how many people are currently right now offering home equity products. So if you can actually just please, give us a response here. If you're offering them, I want to know if you're offering them. If you offer them, but maybe refer them out to other lenders, let us know that, maybe some people are just telling them they just can't help them. So let me know actually what you have here. And by the way, keep those questions coming in. We're going to keep this open for about another 5 seconds here. 5, 4, 3, 2, 1. All right, I'm going to close the poll right now, and I'm going to share the results here. I don't know if you guys can see see the screen here, but we have 53% offer them right now, 28% offer them but refer out to other lenders, like you were talking about, Jerry, and 19% just tell them they can't help them. So
those 19% or 20, just say almost 20% of your customers that you can't help, just because you can't offer them, that doesn't mean they stop. Almost every bank who offers them also offers a first mortgage. The online lenders, they may go to an online lender and borrow that money. They're starting to offer first mortgages. So we think that that's not a smart strategy for people who've worked so hard for the customers. So what we would tell you is, I'm going to summarize, my section here and say, we don't think that you should switch all your marketing and be home equity lenders. We think home equity is an important part of helping your customer base. The same way that you look to help your customer base with non-QM loans for a lot of the self-employed people who can't get approved through traditional product, the same way some of you guys help your customers through construction loans. We think it's another thing that should be in your arsenal so that you could become a full-service supplier of mortgage product for your customers. And it gives you something on a regular basis to talk to your customers about. Because the customer who doesn't do home improvement this year may do it next year. The customer who doesn't have a debt consolidation need this year may have it next year. And what I would tell you in every product, the same way that people I do business with try to keep in touch with me on a regular basis, the more you can keep in touch with somebody rather than just saying, hi, how are you today? And offering something that might serve a purpose and help them solve a need, we think is a good business strategy. And that's really what I wanted to get across today is home equity can be an instigator for your traditional products, your first mortgage products. With that, I'm going to turn it over to you, John.
Thank you, sir. Appreciate your quality input, and as always, it's an honor to be part of this company. I'm excited to be able to share what we've learned as we're researching and working in this segment as it starts to take shape. And we're going to cover a lot of information today, and I'm going to try to keep it fast-paced and as informative as I can. Andrew's recording it, so we're going to share it with everybody. So if you miss anything, you can get the details later. We'll also share the deck. My personal goal for this webinar is to help educate everybody on the call about this emerging segment in our market so that you then can see the value and become your local market expert and use this to gain some higher trusted advisor status in the eyes of your past clients and other referral partners. It's truly a unique product right now. There is nothing really that has been like this, a fixed rate second mortgage product for brokers to get lender paid comp really since 2008. And I'm going to kind of expand on the information that Jerry just shared. I'm going to share some industry expert and leadership insight. I'm going to share some facts about the segment. I'm going to tell you how this relates to your clients and your prospects. We're going to talk about the various competition that's out there for that cash out that Jerry was mentioning. And hopefully at the end, we show enough value to you that you use this strategy to set yourself apart in this really super competitive time, because it really is, like I said, a unique product and hasn't been available since 2008. So we are pretty certain that there's going to be a recession coming, right? Everybody's calling for it. You can see here in Zillow 2020. We also can see that, per the most updated MBA forecasting here, the fixed rate 30-year fixed rate is going to hover over the next 2 years or all around that low 4% range, depending on this. And refinances, in the first quarter, they're going to spike up to 30%, but then they're going to hover around that 25% of the business. So let's just set the stage. Even the best people in business use coaches. And I'm fortunate to have somebody like Jerry as one of my coaches, but I also look to other industry leaders and coaches within the industry. And with this increased competition for other mortgage companies, and now, as Jerry said, newer Fintech companies kind of diving into our space, you need to be giving professional advice as an originator even more so than in the past. So recently I was fortunate enough to see Barry Habib speak, and he provided a ton of value. He used historical facts about the cycles in the business. Bottom line, Barry and other experts are saying there's a recession coming. So, we should, according to him, enjoy the current market, but remember 10 years ago and how that changed our industry. Barry spent a lot of time during his talk focusing on how you as the originator need to look for every way to maximize your past customer database and stay relevant to them even if they're not moving again anytime soon. So he went on to say that LOs that say they're purchase focused and that they don't do refis are really just approaching the business as kind of a transactional originator, and they should really reconsider that approach and be that trusted advisor with a customer for life strategy. And he he further went on to talk about the energy and expense, like Jerry was just talking about, it takes to get a client, and then a trusted advisor can hold on to that past customer versus, pushing a button and getting a mortgage, or versus the fintech and tech-reliant mortgage competitors are stepping into this environment right now. So another top-level coach that I've listened to and used in the past, Dave Savage from Mortgage Coach, he says this annual mortgage review is kind of an essential focus for the trusted advisors through his Mortgage Coach system. And I think that adding a home equity option to your client for life strategy, especially those that have a very low first mortgage rate, just makes sense. And providing multiple options in this Mortgage Coach strategy with their total cost analysis is kind of at the heart of their system. And we think the home equity product, the second mortgage, is a great tool for that. And many of you guys know, go ahead.
Yeah, I'm just saying, you talk about the annual reviews. I thought, because I'm curious how many people on this call have a formal follow-up process. You and I both know how important it is, but I'm just curious, from the people that are on this call, how many people have an actual formal follow-up process? Because, we've always been led to believe that, we should be purchase focus. But as we're learning, we listen to guys like Barry, people actually that are teaching us to be more of that, mortgage professional for life, we're learning that strategy is flawed. Tools like what you guys are doing here make it actually more sense and make it actually more incentive for us to do these annual reviews. But we're going to keep this open for another 5 seconds here to see actually what we're going to have. So if anyone has any last-minute submissions here, all right, we are going to close this. And let's share the results here. So looks like we have, from the people that have, just under 50% don't have a formal follow-up process, but know that they should. Another 13% just don't have a formal follow-up process. And 40% actually have a formal follow-up process. So I don't know, John, if that's in line with what you were thinking actually we get out of that, but we have only 40% are putting this into place.
This is Jerry, John, if I could jump in for a second.
Yes,
this
sir.
is one of the best practices that we recommend. Most of your loans have been a purchase money where you were lucky enough to assist somebody in one of the major purchases of their life and putting them in a home. 6 months later, or a year later, or both, what we would recommend is sending an email, or even more personal, a card, and say, how do you like your house? Hope everything is going well. Hey, just want you to know we have a program that in case you need to do something to your house, landscaping, new HVAC system, new pool, we have a product for you. But either way, I was really just checking on you to make sure that everything worked out well for you. Keep in touch. Best, you. That's something that we really recommend, and it's a great way to instigate, clearly home equity, but it's really a way to instigate your customer. And a customer, we all spend so much time during the closing process. How much time do we spend after that? Maybe that customer is at a party in their neighborhood that night and talking about somebody wants to refinance, or your name is top of mind. So that's why it's a good follow-up process, and that's why there's a good product to do that with. I'm sorry to interrupt, John.
No, anytime. That's interrupt me as you see fit. I'm here. So just kind of to get back to this, a lot of you probably know who this guy is, Todd Duncan, and he's anticipating and just recently put out there 18 months. Within the next 18 months, there's going to be some massive disruption. And one of the reasons he brought that up is to say that he's truly emphasizing creative follow-up and deeper conversations as kind of his list for high trust approach. And that leads into the conversations that Jerry was just talking about. And you can further see this strategic shift in large companies' leadership and how they're reacting to this new market, like the CEO of Finance America, Bill Dallas, publicly sharing his strategy on this loyalty type program to try to maintain his company's customers after closing because they sell the servicing. So using what he published as a debt advice or financial wellness, it really just shows to me how everyone's focused on trying to hold on to the value of their customer. And you can even take it a step further. A lot of wholesale investors, like our friends at Caliber and my buddy John Gibson, they rolled out this Reconnect program to create customers for life. And then you can see again, Phil Shoemaker at Home Point is recently talked about at a name convention, but also on this LinkedIn post about only 14% of brokers are capturing their past clients' business, which is a very low number. And if you take, kind of continuing on this viewpoint of today's industry leaders, look at how Matt Ishbia sees one of UWM's focuses, helping others without expecting anything in return. And I think this is a very strong parallel to that trusted advisor mindset, because basically to be a trusted advisor, you have to provide trust without the expectations, without kind of cramming them into a first mortgage cash out because that's the only product you have. Now you've got some other options, and maybe the second mortgage is better. Maybe the first is, but now you at least have some options to show him. And then as we finally wrap up these viewpoints of industry leaders, Joe Willou, the CEO of Total Expert, which is a marketing operating system, said in a recent interview, and these guys truly are mortgage client data experts. He said the customer lifetime value is the key to long-term profitability for mortgage companies. And we're going to get back to that in a little bit later. But I think to further confirm the enhanced focus just on the industry as a whole for this customer for life, in this recent article on Housing Wire, they talked about how servicers are really using technology and data to hold on and retain and maximize the value of the customers that they're servicing. So everyone, this is kind of top of mind, so everyone's fighting to hold on to the customer. So it's even more important for you as the originator, who, as Jerry said earlier, was trusted with the largest purchase of their life. You're the one that they trusted with the biggest purchase. You're the one that should be giving them advice on home equity or first mortgage, not a personal loan online lender. So all of this is important, and you can see here, I wanted to show you this. This is the basically outstanding tappable equity with first loans. Now, when this chart was taken, and there's no update here from Black Knight, it shows 75% of borrowers have a lower rate than 4.5, right? But if we update that to kind of a more current environment with lower rates, 67% of borrowers have lower than a 4.25. So refinancing a certain percentage of these homeowners just may not make sense for them. And it may not make sense for them to even want to talk to you about it because they think their rate's fine and they have maybe refi burnout. So a second mortgage option might be a good way to get the conversation started. And then you can do a comparison or your version of presenting options of a first mortgage cash out refi versus a standalone second. And then you can give them the options. And this product gives you the tools to share the options with them that you previously didn't have. And so that brings up the facts.
Even in this, John, even in this interest rate environment where, temporarily, we don't know how long that is, but interest rates have gone down again, there are still a lot of 2015 and 2016 vintages where it just doesn't pay for people to refinance to take out, $30,000, $40,000, $50,000 of cash.
Yes, sir. And that kind of brings up the facts here about the home equity market. So right now, or earlier this year, there was 15 trillion, it's probably a little bit more now, 15 trillion in equity right now in the U.S. And looking ahead, the home equity market is expected to double from the recent past through 2022. So that's one of the main reasons why Jerry started Spring at the time he did. He saw that we were at the bottom of the curve and it's going to continue to grow. And if you look back as recently, Jerry said this earlier, look back as recently as last year, and you can see this chart, by quarter, the equity tapped by home equity loans was $140 billion for second mortgages. And kind of to correlate that, 82% of first mortgages towards the end of the year were cash out refis, which shows to me that borrowers want to tap their equity. And we all know that, right? So I think there's a lot to think about in relationship to the value of this product. But if you look at future opportunities from the loan officer perspective, you can see here in this recent study from Altisource that non-QM is in the top of the categories. You can see that. And we all know there's a ton of energy in this space. There's a lot of new and existing companies that are focused on this segment. And then if you look at the home equity, and we just talked about this, $140 billion in 2018. And just to compare that to 2018 non-QM volume was 11.9 billion. So it was actually just 8.5% of the size of that home equity market. So we're suggesting now that you get on the bus early and you understand this product and you start to use it to serve your clients with options and don't miss the opportunities, because our product can be useful in all seasons. You should see value in this type of market. And as we shift, into a different market towards the recession, this product is also is a good product at that time. So just kind of recap, you can see from this Experian white paper, the estimated market potential for home equities is just the potential market, right? Not what they anticipate is going to close. We don't see this going away anytime soon, wearing out. So it's a great product to get on board with now. And you can see that there's a lot of promising expectations in this space. There's 10 million consumers are expected to take out home equity seconds between last year through 2022. According to TransUnion, this market is poised for growth. And this segment's not just for, California and New York. It's not just for the high cost areas because of all their equity and appreciation, but middle America communities, as mentioned in this recent article here in Central Ohio, home equity loans are surging in all markets across the country. So we've also been seeing this increased media attention on home equity lending over the past 12 months. Like the Chrisman blog, it was talking about home equities where, 2 years ago, there wasn't a mention. Ellie Mae late last year added a HELOC module for their functionality. And then if you look at Ellie Mae statistics, so these are closed loans, and Jerry touched on this, closed loans in 2017, 18, and 19, you can see that all of these folks are hovering very close to that 80% range, which really kind of almost takes them out of a benefit of a traditional cash out refi, and it really leaves the door open for one of the only options is a second mortgage if they want to tap into their equity. So as we move forward with everything we just laid out, I think we could all agree now that to understand the value of your customers is even more important today than maybe it was a couple years ago. Anyone on the phone that wants to exponentially step up their marketing game, you may or may not know this guy, but Jay Abraham is amazing. He has a ton of free information out there, and I suggest you search him and look him up, and there is a ton of free information. But one of the things he did was when defining the customer lifetime value, Jay said your clients equal the assets to your business. So when you think about that, since most of us rely on this month-to-month production, meaning we don't get residuals for brokering loans, our database of past clients is our residual. And that's kind of detailed out here in this survey from the 2018 most originators valued their past clients and their client database at or near the top of one of their most valuable resources. But the problem is only 42% of companies know how to accurately measure the customer lifetime value. So back to what Joe Willou said, customer lifetime value is key. So how would we define the customer lifetime value? How do we look at that and see, what our database value is? And one way to do that is through this data tree study. And they defined the value of a mortgage customer in today's market as 2 mortgages and a home equity. So if this truly is the value of your customer, the lifetime value of your customer, this is what your database looks like. Your database visual, the value of your database visual could be this. So for future discussions, we're going to share ideas on how you can target this piece of your business, how you can maximize. And I know Jerry shared a few examples, and really kind of get the best return on that cost that you acquired to, or costed to acquire the new customer. So we will dive deeper into the competition kind of moving forward. But for this meeting, we're going to cover it at a high level, and I think a goal as originators is to truly understand all the options that customers have at their disposal to get cash. And so I would venture to guess, and Andrew, I didn't ask you to put a poll on for this, and I should have. Most people, when they think of a home equity loan, they think of a HELOC. And, we, in a study here, in a recent white paper from TransUnion, they defined home equity originations in 3 ways, right? A HELOC, which we just talked about, a HE loan, or a fixed rate mortgage, which we're talking about right now, or a cash out refi. And we all on this phone know that the cash out refi is the preferred method for us as LOs. But as a trusted advisor, you now have the ability to show options along with that cash out if the borrower decides they don't want to touch their existing first. So that's what we're doing. We're going to dive deeper, like I said, in the competition. But when you look at a HELOC, you know that a HELOC typically has an intro rate, interest only for a period of time, which doesn't pay any principal down. It usually has a variable rate feature tied to prime. And as Barry Habib said in the speech or the presentation I saw him do it, he said, trusted advice sometimes involves sharing the bad news of an option too. Like, don't just hide all the bad news about a HELOC. You have to share that information, is what he was trying to say. So I think, did you want to add something there, Jerry? I'm sorry.
No, I'm good.
Yeah, I'm just going to say this. I think this is amazing. We have not had one person drop off. I mean, we do a lot of these webinars. People actually, get tied up in things. This is, I think we have a group of people that understand how important this opportunity is. So I apologize for interrupting, but I just think that's phenomenal. And I think we got some smart people on this webinar.
We'd like to think so too.
I just hope there wasn't 2 people that just stayed. No, I'm kidding.
There's only one left. No. So I think this kind of ties all this together. In a recent LendingTree study on home equity trends, 64% of all borrowers said they were concerned about the variable nature of a HELOC. And if you look a little bit further into this study that they put out there, Navy Federal Credit Union, who's probably one of the largest home equity, if not the largest home equity lender in the country, they expect as rates go up and continue to go up that people are going to want to, lock that rate in at a fixed rate. And they're already starting to see people wanting to switch and go for that certainty as opposed to wonder what's going to happen to prime and how, what's going to happen to their payment, their rate, their adjustable product. And in addition, there was a J.D. Power and Associate HELOC satisfaction study that kind of reiterated what we're seeing. People are concerned about the variable nature of the product, and they're concerned about the fact that the payment's going to increase after that interest-only period. So one last thing about the home equity loan versus the home equity line, you can go to Bankrate, and I have the links here, and you'll see it all in the deck that we send out. But this is a pretty cool tool. They have it like, it's a recommendation tool. Should I take a home equity loan? Should I take a home equity line of credit? Well, there's 3 key questions really that kind of lead this tool to recommend a home equity or HE loan, fixed rate second. And the first one is, if the borrowers just want a chunk of cash and don't want to continually borrow periodically, it's going to recommend a HE loan. If they want to pay it back more than 3 years, it's going to recommend a HE loan. And the reason that, at that 3-year mark, really, it's because nobody knows what's going to happen to prime 3 years from now. Nobody knows what that adjustable rate is going to be like. So they're recommending you lock in with a fixed rate. And then also, if you want equal payments and you want something you can budget to and not have to worry about if the payment goes up or not, they're going to recommend a HE loan. So this tool is a pretty cool tool when you're talking about it. It's a useful tool. And another option for cash out is obviously a cash out first. We know this is a preferred way, as we talked about, for most companies, because that's what you're used to, and you get paid more for that because it's a bigger loan. But as we know, there's large hits for cash out. So as you're presenting cash out first, you should at least know that your competition may be proposing a second. So this is good to know, and it's good to have the options. And part of being...
John,
go ahead.
John, I'm going to jump in here for a second, because if you go back to that chart is a really important thing that if I would like people on the phone to get across. We think by presenting the home equity option, it could help you reinforce why people should redo their first. because in some of those options, the first rate will be better than the blended rate. And in other one of those options, you'll find that the blended rate or the lower cost to get into a cash out standalone second are better. But if you use a chart like this, it really helps you bring your customer along, that you've looked at various different opportunities to give them the best financing for their need. And in a lot of instances, I think that's going to help drive that customer to your cash out. And in some, I think it will help drive them to the standalone. That's really important chart that John has put up on this presentation.
Thank you, sir. No, good point. Good point. And I think, part of being that consultative loan officer versus an order taker is kind of understand what you just talked about, but also try to understand the emotion behind why people tap into their equity and see the majority of uses within this chart here. It's the top two are remodeling and debt consolidation. And now I know that, that adds up to more than 100%. And the reason why that adds up to more than 100%, a lot of people consolidate their debt. Let's say they have $25,000 in credit card and they want to do $50,000 worth of work in their house. They combine those two so their net outlay is actually less. And in some cases, it might even be, cheaper than what they were paying on their credit card. So we're going to have some future trainings on that, on how to dive a little bit deeper into home improvement options. We've got some tools that'll help you, plug in the numbers, and it'll show you the savings and something you can present to your borrower. Even if your borrowers bought a new construction home, it's amazing that there's always something that they want to do to improve it, whether it's a patio or a deck or a pool or upgrading something in the house, or they had an unfinished bonus room. Now they want to do that. And if they're buying a resale house, kitchen upgrade, finished basement, bathroom upgrade. So there's a lot of, opportunities here for people that have just purchased a home and you don't think that they're ready to do anything. And consider the fact that as a trusted advisor, we tell our borrowers during the process of buying a house, don't make any purchases, don't do anything crazy with your credit. Borrowers are going to use the proceed from the sale of their house as a down payment for the new house that you just closed on, and now they're somewhat cash strapped. So after settlement, what happens? They get new furniture, they get a new car for that driveway. They can't park their old car in the new house. And you know what? Lowe's and Home Depot and credit card companies and fintech companies and banks and credit unions, they know this. So that's why when somebody moves into a house, they're getting a lot of this stuff, these solicitations, because they know that that's what people do. So if you want to read about kind of a real life example of that, check out my LinkedIn article that I put together on new construction purchase and a homeowner wanting to upgrade. It's called "If You Want to Be a Trusted Advisor, Then Give Trusted Advice." But I think that's the reality of what our borrowers are doing. And it makes sense. You can see that, and I know Jerry talked about this earlier, but by 2022, it's projected that there's going to be $464 billion in sales in home improvements. And some of the things that we're going to share as an organization and will continue to share to educate you on the home equity is things like this. You can see the home improvements, a large reason why people tap into equity. Here's a breakdown by project. You can also see this same survey, 55% of home improvement people are going to actually borrow in some fashion to do their home improvements. So I think, and this isn't something I'm going to read through, but this is from the CoreLogic economists, basically confirming what we're saying about renovating versus moving. Homeowners are living in their homes longer than they did a decade ago. We know that. People aren't moving up as much. And the desire to stay put's kind of fueled this ambitious renovation trend. So we know that's going to happen. But again, we're going to talk about that a little bit in another session, but we do know that the customers are getting bombarded. So talking about competition, we know that credit card transfers, personal loans, cash out refis from other lenders. People are all over that. We also know, unfortunately, and hopefully none of you have experienced this, but what I'm hearing is that borrowers aren't as loyal and they're shopping a lot more. This shows that if you want to maintain the value of your past customer base, it's even more important to have a valuable, trusted advisor option and letting your customers go somewhere else. So as you can see here, 36% more borrowers shopped than compared to 5 years ago. So even though they're doing a first mortgage for you, if you're not providing value with a product like ours or with something similar to that, they're going to start shopping you. And then the majority of HELOC customers are considering other options basically because of what we said earlier, the variable rate and the higher payments after the draw. So by having that fixed rate product, and we'll talk a little bit about how well our product compares to a HELOC, but I think another option for these folks is really credit cards, and you probably see it. People they buy their furniture, they upgrade their house on credit cards, and just as well as anybody else, those rates are not very friendly. And you also can see here, I thought this was very interesting, that keep in mind, the more people make, oftentimes, the more they spend and overextend. And what this chart shows is that even the highest earners, that 90 to 100%, percentile, they are just as likely to pay the minimum amount on credit cards as the below average income. And that was pretty fascinating to me because I never would have even thought that until I saw this survey. And that makes sense. You're going to see these people that are making a ton of money and they're spending it just as fast. So when we get to personal loans, and I know that Jerry talked about this a little bit, personal loans are a pretty interesting story, right? There's some of these larger fintech companies that came into the market after the crash, mainly for student loan refinancing. And now, look, 2018, there's $125 billion in personal loans. And the interesting part here is you can see, look at the fintech market share from 5 years ago is 5%. Now it's 38%, the largest share of any of these other institutions. So if you let your customers make these decisions without your input, these fintechs are going to be taking your customers, the customer for life. So I think it's important to kind of be on top of this, have the options. And then when you look at, here's the rates. If you look at excellent credit, poor credit, average, you can see the rates for these personal loans. Over 60% of borrowers took out a personal loan to consolidate or refinance credit cards. That's where a trusted advisor can kind of step in and help guide them through the options. And kind of as I wrap this up, when you look at consolidating a personal loan or home improvements or any of this other debt, we're just trying to show you the information that we know to help you in just kind of navigating through this emerging market. And our goal, I know we've covered a ton of material here. We've covered a ton. And hopefully you found it useful. Went through it pretty fast, so I'm going to give you my contact information. Call me with any questions. Be happy to help you out with anything I can, answer any questions. I know Andrew's probably got some questions there that we can try to answer, and if not, we'll just make sure we get it out to everybody. But we're going to have future breakout type webinars in the deck that we'll provide. I'm not going to go through this, but here's some actual examples of how we've helped borrowers. We've got highlights. So today was not about pitching Spring EQ. It was about sharing why we think this should be an important part of all mortgage company strategy moving forward. Here's some highlights about our product and just kind of a quick highlight. We had a product meeting earlier today, and Jerry was there, and kind of the largest percentage of our production right now is a 20-year fixed. Okay, so we do 30-year fixed, but the largest percentage is 20-year fixed. And as an example, 75 CLTV, 20-year fixed, our rate is prime minus 30 basis points. So that situation, it's an absolute no-brainer. Fixed rate, prime minus 30 versus a HELOC, it just doesn't make sense. So I talked about a couple of these tools that we'll provide you as partners, existing partners, or soon-to-be new partners, we hope. We've got the estimated revenue model, which basically helps you guesstimate how much revenue you can make by offering these products to your past customer base. We have a cash out refi versus a standalone second mortgage tool. We have a home improvement with debt consolidation monthly savings tool. It's a tool you can plug in, $25,000 of credit card at this rate, $50,000 worth of work, amortized. Here's your payment, so it'll help you in selling that. I'm sure that if you're using a system like Mortgage Coach or some of these others, it has tools like that as well. We have a jumbo versus conventional with a piggyback tool. We have a customer lifetime value tool. So if you're like, I don't even know how much my database is worth, we can kind of help you. And then if you have and we also have a HELOC versus a HELOAN tool. So what we're really trying to do is reach out to us. This will be on the deck. You can either go to the contact page and contact me directly, and I'll get you connected with your local account executive. And if you're an existing partner that signed up here and you want to either get some additional training or a refresher, or you need some help with a registration because now you're excited about the product, let us know. If you want marketing templates, we have those opportunity tools I talked about, our marketing support team. And then really what we're trying to do is help you maximize the customer lifetime value of your database. And, we appreciate your time. And Andrew, I'm going to turn it back to you. And
John, let me jump in for a second. This is Jerry.
Oh, yeah.
First of all, thank you, John. And Andrew, I just wanted to thank you for giving us the forum, and all of you people out there, I want to thank you for taking your time up and listening to what we have to say. I'll end with one final thought. Mortgage brokers and mortgage bankers, non-depositories, are 51% of the overall mortgage market. That used to be a market that used to be owned by banks years ago. The banks used to own a lot of the personal loan marketplace. They've been disrupted by the Fintech lenders. Home equity is 99% owned by banks. We're just telling you guys, the mortgage broker business is growing. We're just telling you guys, get your fair share. It's in front of you. And use it as a way to instigate your core business. That's my one simple message for you guys. So thank you, everybody. And Andrew, I'll turn it over to you.
Awesome. Thank you so much, Jerry. I really appreciate it. I mean, so listen, if you know Jerry's past, Jerry has caught actually, the beginnings of booms for many opportunities in the mortgage space. So it comes with actually a lot of credibility. So now got a bunch of questions here. I'm just going to launch one little quick poll. We got 10 minutes left here. I just want to know, so during this webinar, have you thought of borrowers that would be perfect for home equity? So just I'm curious actually, because I know a lot of people actually, you start to think about this. And do you have some in mind? Did you start a list? If you didn't, start that list now. And maybe you haven't. Maybe you're not thinking of yet. But this has been a great opportunity. John, unbelievable amount of information that somehow you managed to flow through it really well. I feel like I got a lot of information. We are recording this, so we're going to send this out to everyone. So if you didn't take notes, you'll have the opportunity. I'm going to close this poll out, and then we're going to start hitting everyone with questions. 64% of the people actually on this that already have people in mind, and 12% have even just started a list. That they're actually having a list of people. Those are people that are going to have a nice, healthy home equity full July and August. So very cool. Without further ado, we're going to hit some of these questions. There's a lot of questions here. A lot of people asking about, let's see, let's go to this first one here. Refer. Do you see a lot of these loans being used for solar panels?
This is Jerry. There are some, but a lot of the solar financing, some of the dealer financing is paying down the financing cost. So they're really in that space, and some of these guys have PACE loans. So sometimes, but not as much, to be honest with you.
Got it. Okay, great. How competitive is this compared to bank products?
Great question. First of all, banks have a sweet spot that's generally about 740 FICO to about 89% CLTV. And they get, so banks have a tighter underwriting guideline. And in that sweet spot in the 740, 75, 80% LTV, the banks are normally about prime, and they'll start it off on a HELOC with a prime minus something. So generally speaking, we would expect them to be a little bit better than us in that segment. But what John talked to you about with the rundown in treasuries and the way we price our product, our rate it could be a little bit over their start rate. It'll be over their start rate, but their fully indexed rate we're toe-to-toe with. So the question is, does somebody want 6 months lower in rate, or do they want a fixed amount for the remainder of the loan? The other place where our product picks up, where banks don't tend to, the average, we get a lot of customers in the 80 to 90, 95% plus CLTV range, and a lot of those places where banks don't go. And what we find is our customers are a little bit more indebted than some of the banks approve. So we think those are our sweet spots. But right now our pricing, even in the bank sweet spot, is pretty darn good.
And just, Andrew, to add to that, we have a tool that they can plug in the bank's information and how long the introductory rate is, and it shows the principal reduction. It shows the payment both before and after the adjustment, and you can put in there a guesstimate of how much you think it'll adjust in that 5 or 10 year period. And it's a good way to kind of give your borrower a true visual. And even if they go back to the bank, at least you've helped them understand the options and know what they're getting into when they're going to go get a HELOC.
Sweet. Very cool.
Yeah, but what I would tell you, there's just the same way with the rest of the mortgage product. Sometimes there are places where banks will win. We think there's a lot of places where our product will win. And the other part that we think our product really wins in is in the ease of use and the service. In the process of setting up this company, I've taken out more credit lines just to see the process. This product doesn't have to take a long time. It could be very fast. You know, the average, if we get the appropriate documentation and the appropriate cooperation from the client, these loans fund in a couple weeks because of the simplicity of it. And a lot of banks, some do, but a lot of banks can't do that.
Fantastic. I got the next question. You're asking, how do we get paid? Or he's basically saying, what's in it for me? So
let me take that one, Jerry.
Sure.
Yeah, so it's just like a first mortgage lender paid compensation. Right now we're set where our rates out there now all pay 1.5 lender paid comp within the next 45 days. Is that about right, Jerry? We will open it up to other options, and you can be flexible to do just like you would on a first mortgage, and we'll have a borrower paid option as well. So if you're not signed up with us, and you're going to get signed up probably by the time you do your first loan, we'll have that in place.
But they're getting paid a 1.5. Clearly not the same amount that somebody's going to make on the first mortgage, but we think that's an amount that they would make based upon their customer list. And as I said earlier, we think it's a product that helps you drive your higher margin product.
Yeah. I said, listen, we should be doing these, the annual reviews anyway. This is just another compensating factor that, or another incentive to do something that we really should be doing anyway. As far as amortization schedules, 15-year, 20-year, 25-year, 30, what do you guys offer?
5 to 30 year.
5 to 30 year. Fantastic. All right. Let's go to this next one here. We got 4 people asking if you offer this in Texas. Texans are used to being ignored.
In spite of our home field being in Philadelphia and the Eagles, we do offer this product in Texas, but as the Texas people know, there are a little bit different rules on some of it.
That's great. Fantastic. So someone is asking if they can charge an origination fee. I think you kind of just addressed that, but if you want to take that on directly.
No, at this
what
point,
we'll do is because different states have different answers to that, so I think that's best served outside of this call.
Fantastic. Okay. What are the qualifications that you're looking, or customer requirements?
Well, to underwrite a customer, we ask for a few simple things: a copy of their license, a copy of their first mortgage statement, a copy of their insurance, and their income documentation. There's no assets required. And if we get all of those information through our portal, we could render a decision very quickly. And as I said, since there is a TRID on these because they're closed-end loan, the shortest amount of time you could fund is 11 days. We could fund right about that time if we have everything up front from a customer. What we want to do is make this a simple process. It's based upon the customer's credit depth. It's based upon their income qualification, and of course their CLTV. And the great thing about it is most of the loans do not have an appraisal that somebody's going into the house. It's an enhanced BPO where we're doing basically a drive-by on most of the properties. Now, if somebody's had work done on the inside, we're not going to get the value on that basis. So we have to have a modified product where we send somebody inside. So the process is fast because they're not waiting for an appraiser to schedule something within the house, and it's not intrusive on the customer either.
Fantastic. So listen, I mean, we do have, there's a bunch of other questions here, but I always try to do what we can to kind of try to quit these on time. So Jerry, John, thank you guys so much. I mean, unbelievable amount of information. I mean, I can't believe how much you've shared in just 60 minutes. I think actually our attendees really do appreciate this because most of them have stayed on. So really appreciate this. I'm looking forward to doing hopefully another one with you guys. Maybe we could do a little deeper dive into the product. But if you guys want to close this out, any closing statements?
This is just Jerry. I just want to thank everybody for their time, and I want to thank Andrew, you and your group for setting it up.
Absolutely. Yeah. Thank you, Andrew, and thank you, everyone, for joining the call.
All right, guys. Thank you so much. And again, this is Andrew Berman. You've been listening to another NMP webinar. Thank you guys so much. We got more great ones coming up later on in the month of July and through the rest of the year. All right, everyone, have a great summer, and we'll see you on here soon.